All right, so here we have our next speaker, ladies and gentlemen. Please put your hands together for Mr. Shivom Ashutosh Chakravarti, Senior Economist, Global Market, ICICI Bank. Sir, I will just take 2 minutes. So, ladies and gentlemen, this man doesn't need introduction, but let me still introduce him to all of you. He's a senior economist of ICICI Bank, has around 15 years of experience as a treasurer economic with experience in Indian macroeconomic, global macroeconomic, and the global market. He was part of the team that was ranked as the best forecast for the INR by Boomerang in 2008, 10, and 16. His previous stints includes HDFC Bank, ABN, Amro Bank, and Economic Times. He's here with us today. Let's begin the session with a thunderous round of applause. Everybody, come on. I want to see the energy in the room. Over to you, sir. Thank you.
Yeah.
You want to use the podium or you want this? Yes. You'll use the podium? Yeah. Yes. The team will help you build the
Slides on? Okay. Yeah, hi. Yeah, so thank you so much for the introduction. I felt like a Bollywood actor, not an economist, coming on stage with that kind of applause. So thank you for that a lot. So I thank the Bagaria Group for giving my team, my bank, the opportunity to present our thoughts on the global economy and the Indian, how India stands as far as the global economy is concerned. Just some quick thoughts. I'll just run through our presentation. Before I start and getting through our forecast, I think one thing I need to emphasize, just 1 second. Yeah. One thing that I need to probably emphasize is, economic forecasting tends to be more of an art rather than a science. It's a scientific art, so we keep revising our forecasts based on different challenges that confront us. Each business cycle is different. So the pandemic cycle has proven to be a challenging period from a forecasting perspective. I think the lockdowns and the reopening and the policy stimulus resulted in continuous sort of revisions in terms of growth forecasts. I think what we find is that the global economy recovered very sharply in 2020-21. Lockdowns were eased. But we saw a record fiscal stimulus driven by the US economy and several other economies. So in US, you had about a 25% fiscal stimulus to GDP, out of which 11% came in the form of direct cash transfers that resulted in the US economy surging forward and leading in terms of the growth momentum. China initially recovered in 2021 and then stuttered in 2022 because of the lockdowns that were in place. Europe actually was, for a change, keeping up pace with US because they had their own fiscal stimulus. And unlike the US counterparts, the government had provided guarantees to the corporates, telling them that we'll guarantee your credit risk as long as you don't reduce your payroll. So income growth was very strong. But then came the energy crisis, and European growth was hit quite hard in 2022. The unusual part of this recession that we've just come out of is the fact that we had a huge output shock. Economy output contracted sharply in 21, but then income growth was very strong. So that has really sustained the recovery. In India, unlike the rest of the world, we had a more capex focus kind of fiscal response. We have structurally gone higher. I think one of the impressive parts as far as Indian economy is concerned is the public spending. That's the government spending on infrastructure, which was about 1.5% of GDP prior to the pandemic, increased to about 3.5% of GDP. So that has worked as a backbone pivot. It was also unusual in India in the sense that we had a formal sector which was able to divert into a hybrid model. Labor markets in India were very strong. So as reopening happened, we saw a huge surge in services momentum. Overall, as far as the outlook is concerned, we think that global economy growth will slow. What has surprised us to the upside is the US growth, which has been fairly resilient. We keep reviewing our forecasts, and I think based on current data, we think that US economy, the growth momentum has been strong. Income growth has been that strong because of the 11% transfer. Labor market strength has been strong. The supply of labor has shrunk in the US economy. A lot of the population who are 55 and over have left, so you're seeing a huge wage price spiral. So US economy growth outlook remains fairly constructive. Growth will slow, but it will still be around its trend pace. Europe, we think growth will remain fairly weak. driven by the fact that it is still recovering from the energy crisis. China is where we would express our greatest concerns as far as growth momentum is concerned. And as far as India is concerned, I think it's fairly visible. Domestic demand momentum is very strong. The government's capex drive, PLI schemes should continue to usher in a fairly above strong, robust growth of about above trend level growth of about 6% or 6 to 6.5% over the next 2 years or so. So overall, a slowing global economy led by US strength, pockets of weakness from Europe and China, and India holding its own given the kind of capex drive and strong domestic demand momentum that we have at this point in time. I just wanted to highlight some slides on the U.S. economy. I think the story for as far as 23 has been concerned has been the kind of resilience that you've seen in U.S. economy, labor market in particular, job openings. I think this is important from a growth standpoint. Job openings that were averaging about 5 to 6 million during the pre-pandemic period have skyrocketed to about close to 9 million or so. So there is a huge demand for labor. Income growth is strong. U.S. growth outlook remains strong and will remain the backbone as far as the recovery is concerned. I think we get a lot of questions on what central banks will do going forward. So I talked about the kind of policy response and stimulus that we had globally. That has really resulted in a very sharp increase in inflation across all developed markets, and that was somewhat exaggerated by the energy crisis that we saw during the 2022 period. So in that sense, we've seen an inflation spiral. We think inflation has peaked and is gradually moving lower. US, we think, inflation is unlikely to drop below the Fed's target level in a hurry. So the central bank will keep rates fairly elevated for a considerable period of time. For India, what that means is basically your exchange rate pressures, sharp appreciation pressures will remain limited because fund flows into the US markets will likely remain in place. Going forward, we think Fed will be on a status quo for 23 and maybe start delivering insurance rate cuts in 24, and that's when we could see a more pronounced revival as far as fund flows into the Indian markets are concerned. Although we are seeing a fair hefty amount into the equity market that is coming in because of the local growth momentum, but then given that given the Fed's policy stance, given the pivot that we would expect in the second half of 24, we think that will increase by a substantial degree going forward, and that will benefit both equity markets and the debt markets. China is really where the main concern is. It's a very unusual kind of growth cycle, I think, with China. I think it's very important because when you're looking at the global landscape, that is where your main downside risk is coming from. The property sector, which is about 25% of the economy directly in China, 40% indirectly in terms of its multiplier effect it has for various other sectors. And interestingly, 60% of Chinese urban household assets are in the real estate sector. They are, a lot of the real estate companies have delivered structured products, and therefore the exposure of Chinese households to real estate sector is fairly prominent. What happened is that during the last given that it has witnessed huge amount of government support, policy support, there has been a huge degree of overcapacity that has built up. There has been an asset liability mismanagement in several of the major Chinese household real estate companies, and that has resulted in a much weaker growth trajectory, which we think will happen until and unless the Chinese property sector stabilizes. This form of risk will remain in place. People keep asking me, China's down, India's positive. I think to a degree it does matter because fund allocations to India will pick up by a degree. But from a growth standpoint, China really poses the biggest risk. Unless the property sector stabilizes, we don't see a sharp revival in growth as far as China is concerned. And from a global front, that's something just to keep in mind going forward. Coming into India, as I was saying, I think the Indian economy growth did slow down quite sharply in response to the pandemic. The lockdowns were pretty severe. But I think what has happened structurally is that we have seen a much higher public capex cycle, as I was emphasizing earlier. Urban demand has remained strong. Formal sector demand has remained strong. The first wave of recovery as far as the Indian economy is concerned in fiscal year 22 came from a fairly robust industrial sector growth that really was driven by greater degree of consumption in terms of goods because people were staying at home, so they demanded goods. Restocking cycle picked up. Export momentum was fairly strong. Then as we reopened, the pivot went towards services. High contact services demand was fairly strong and fairly robust, and that meant that services growth picked up quite sharply. Urban income growth is fairly strong, and I think services exports, GCC, business services exports, not just software, actually have gone structurally higher. So all of that points towards a fairly strong growth in fiscal year 23. Going into fiscal year 24, we think that some of the pent-up demand-driven surge will moderate to a degree, and that services momentum will go back to its trend pace. Industrial momentum is continuing to be supported by strong investment demand. Public capex, government capex is very strong. That will remain the backbone, and we assume a fairly normal monsoon. So we're looking at trend pace of growth in the Indian economy of about 6 to 6.5%. That compares with below trend pace for all the major economies. So from that standpoint, we are structurally probably a little better going forward. As far as structural changes, as I was talking about, I think this slide just summarizes the kind of structural changes that has happened in the Indian economy. We've seen a huge investment-related push. Investment demand is much higher. A lot of it has come from the government capex side, and that will probably remain the backbone of growth as far as fiscal year 24 is concerned. As far as the RBI is concerned, I think we are in the midst of a temporary vegetable price shock. We think that inflation will be higher in Q2. But we view the current vegetable price shock as being slightly more transitory. I think that's the messaging that we get from the RBI governor as well. So overall, we think inflation will be within the central bank's target band. So the need for the central bank to tighten policy further from a inflation perspective remains fairly limited at this point in time. Sorry. However, I think they will have to continue to monitor what the central bank does, the US central bank does. And why that matters, why the Federal Reserve policy matters from an Indian monetary policy perspective is very simple, is if that the Fed is raising rates, the arbitrage between Indian and global rates narrows quite sharply. Capital flows into India comes off a little bit. The currency comes under depreciation. So Indian economy tends to imported inflation picks up by a degree. So at this standpoint, we think that the risk of the Federal Reserve tightening further is limited. So we think that the RBI, both from the fact that domestic inflation will remain fairly modest and the US central bank will probably maintain status quo, will mean that the RBI will keep rates flat. We think rate cuts will probably come in fiscal year 25 sometime, probably around August of next year is where we would see rate cuts coming in. But overall, we see rates remaining flat and we think that overall central bank is on this prolonged pause mode for some period of time, right through fiscal year 24. Coming into the markets perspective, I think exchange rate markets, what we really expect is the dollar is on its last wave of strength. Every business cycle is different. Every cycle that drives the FX rates and equity market cycle is different. What has driven the FX markets in this cycle has been the huge positive income shock that we saw in the US economy that has translated into higher inflation and the Fed tightening policy by a fairly record amount, 500 basis points. We've not seen this kind of 525 basis points. We've not seen this kind of tightening in a long time. That has worked to support the dollar. We think as the Fed is in its last wave of keeping rates higher for longer, and we think rate cuts will start in 2024 from June onwards. So we think dollar will hold its ground for this year, 23, and then gradually start to weaken as far as 2024 is concerned. There are upside risks to the dollar's forecast given the strength of the US economy. As far as the rupee is concerned, I'm not going to touch up on all the other currencies. If there are any questions, I can take that. But as far as the rupee is concerned, we think that it is the overall balance of payments position is better. That is, money is coming in a lot more into the equity markets. We've seen close to $20 billion worth of inflows into equity markets, reflecting strong local growth momentum. Current account position has improved from 2% to 1.5% of GDP. Because oil prices are lower than what they were last year. So the pressure on the INR is limited, but because of RBI's intervention, they're intervening fairly aggressively in the market and trying to make sure that the rupee is flat and is stable. We think dollar INR will probably be around this 82 range for a considerable period of time, assuming very persistent RBI intervention. Euro and CNY are the anti-dollars, so if the dollar trades weaker, then those are the two currencies that appreciate. Pound trajectory is a little flat. It's hindered by a very soft economic outlook that it has. And as far as energy prices are concerned, I think that's important from an Indian market perspective, given that we're a net oil importer. We don't see a sharp move lower. We think that overall We're looking at a very tight physical markets, that is demand and supply balancing each other out. Supply is reducing because of OPEC's decision, Russia reducing supply. Demand is still holding up because of improving mobility from China. So that, in a sense, means that we see an $80 to $90 kind of Brent crude price range remaining in place. So those are our main messages. Just to summarize, the global economy growth will remain fairly weak. So it just looks, lights going all over the place. Yeah. But just to summarize, as far as the global economy is concerned, we think growth will remain, will soften a little bit. There's be considerable inter-country divergence as far as growth prospects are concerned. US growth momentum will be strong. Europe and China will be weak. India will be strong because of inherently strong domestic demand. Inflation rates are peaking out and likely to come down, so the need for central banks to tighten policy further remains limited. The dollar trades sideways and slightly stronger in 23, and as the Fed starts to ease policy, then that probably eases out. The dollar trend will probably ease out going to 2024. As far as the Indian economy is concerned, I think opportunities are plenty given the fairly strong domestic demand that is prevalent. China growth momentum will be fairly weak, so that's another huge positive. And the structural shifts that's happened as far as the growth momentum, the government capex cycle, PLI schemes, software exports being structurally higher and stronger. So all of these mean that we are probably better positioned, comparatively, relatively, as far as the global economy is concerned. Yeah, thank you. Those are my main messages. Thank you for giving me time.